What's up everyone, my name's Robbie, this is Robbie and Mila, and today we are going over not the one, not the two, but the 3 best growth ETFs with Vanguard. Okay, so here's the deal. There are a lot of people in this world who have tremendous brand loyalty when it comes to Vanguard. And for a lot of those people, and maybe you're one of them, you usually tend to look at Vanguard ETFs or index funds before you would even look into another broker's funds. And if you have a Vanguard brokerage account, you can actually invest in other companies' ETFs, like a Fidelity ETF, or a Charles Schwab ETF, or a Spider ETF. But I know that a lot of people really would prefer to start with Vanguard and invest with them if they can. And so just remember that this video is really about the best Vanguard growth ETFs, and I actually don't think that Vanguard's growth ETFs make the list of the best growth ETFs that there are. And if you're wondering what my favorite growth ETFs are, I will put a video here and in the description below. Take a look at that, but those are my 5 favorite growth ETFs, which Vanguard didn't make the list. But all of this aside, you're probably here to see what Vanguard has to offer in terms of its growth ETFs. So let's go ahead, let's get into the video, let's get started. All right, everyone, let's go ahead and jump into the computer. But as we're jumping, hit the like button. Okay, everyone, we're in the computer, and thanks for hitting the like button. Really appreciate that. So we are going to talk about the 3 Vanguard growth ETFs for 2021. None of these are in particular order. I just think they're all good ETFs, growth ETFs that Vanguard offers. So let's go ahead with our number 3. And so here we have the Vanguard Russell 1000 Growth Index Fund, and this is ticker symbol VONG. Let's go through a little summary real quick. So this ETF invests in stocks in the Russell 1000 Growth Index. So if you don't know what the Russell 1000 is, it's the top largest 1,000 companies based on market cap. Think of it like the S&P 500 are the largest 500 companies based on market cap. Russell 1000 are just 500 more, so there's 1,000 of them instead of 500, like the S&P 500. And it's only investing in what they consider to be growth companies, okay? So that's the main thing you need to know. Only companies that fall into the Russell 1000 and only companies that are considered growth companies. And so here we have VONGs, expense ratios, category ranks, stuff like that. So we have an expense ratio nice and low of 0.08%. Most of the time, Vanguard's expense ratio is going to be some of the lowest in the industry. So oftentimes, you won't have to worry about whether or not it's going to have a low enough expense ratio. It's Vanguard. Usually, it's going to be good. This one's good. The 5-year category rank, this means that this is the price performance, not including reinvested dividends, only the price performance of VONG versus its other category type ranks and stuff like that. So 5-year category rank is in the top 19th best. So that means it's good. Oftentimes I like it to be in the top 20%, and this is, so that's good. A growth of $10,000 over 5 years would have grown to $25,809. That's some great growth. And then distribution yield, meaning like companies that pay dividends that end up coming to you in the form of yield via the ETF, 0.77%. So you get a little bit of yield, not much. For the top 10 holdings of VONG, we have the big names. We got Apple, we got Microsoft, Amazon, Facebook, Tesla's in there, Alphabet, okay? Remember, it's based on market cap. The larger the companies are, some of the bigger the weightings. Now, because this is a growth, Russell 1000 growth ETF, the growth companies, which are 455 companies, are the companies in this. And so if you did, let's say, an S&P 500 growth ETF, there would be less than 455 holdings because only 500 companies are in the S&P 500. Let's go to the VONG $10,000 of growth. So how does this look? Remember, this actually includes reinvested dividends. So like we said, there was a little bit of yield. So if you had reinvested that, then this is showing how much your money would have grown to. Now, the blue line is VONG, so $25,809 with reinvested dividends. Versus the S&P 500, $20,304. So this did do quite a bit better than the S&P 500, so I'm very happy to see that. Of course, past performance is not indicative of future returns, but nice to see in the past that this has done well. And a large cap growth category, this has also done better than. So those are things that you kind of want to see. VONG's price returns, so these are not with reinvested dividends, but of course, because there's not a lot of yield, it's kind of okay to look at this. The market price, I usually will go down and see the Russell 1000 growth trailing, and then we'll take a look at this. For example, let's go to the 1 year, 38.49 versus 38.27. So it's supposed to track this index because this is very much an ETF that tracks an index, not necessarily an ETF that's only trying to find certain stocks based on some type of like algorithm or even like an ARK Invest, which is having an actively managed ETF, right? Literally, this is just tracking the Russell 1000 Growth Index, okay? So you're going to see similar returns to from VONG to the Russell 1000 Growth Index, okay? Next, VONG's risk. This is, of course, if you've watched any of my videos, you know this is really the important part. Pay attention to this. This is like the part that I think is going to set whether or not you should buy this or any of the ones I talk about apart, okay? So it's a 4-star rated fund with Morningstar. This is all coming from Morningstar. The risk versus the category is average, so that's fine. It's taking as much risk as all the other ETFs in the same category. You don't want that to be necessarily high if the return is not also high. So this has an average risk, but also an above average return, and that's what you want to see, okay? So then you have the risk volatility measures. Don't necessarily need to go through each of these measures to show you like what is alpha, what is beta, but just know that alpha is higher than the category, and the index is a bit higher, of course, because this tracks the index, so it's fine that it's a little bit below the index, but it's better than the category. Alpha is like outperformance, okay? Beta is how much volatility there is, and it's the same, of course, as the index. And then the category is a bit less. Standard deviation is important. Of course, it's the same as the index, and then the category is a little bit more. So, and then 19.92% or 19.92 for the standard deviation. It's not too bad in terms of volatility, so I'm okay with that personally. Then we go to the capture ratios. So if you're not sure what these are, you might have watched my other videos where I explain this more, but just a quick rundown. An upside capture ratio of 100 would mean that you do exactly what the market does, or the index, being, let's say, the S&P 500. So when the S&P 500, let's say, if it went up, you captured 100% of the upside. But if it also goes down, 100 means that you capture 100% of the downside. So it's nice when you have an upside that's 118, so it's a higher upside, but actually a lower downside. So you're getting more of the upside potential with less of the downside risk, okay? And remember, 100 and 100 means that it's getting the upside and the downside of the index, okay? So this is good. A little bit higher than the category, 118 versus 111, 92 and 92, so the same. The maximum drawdown over the 3-year period was 16% versus the category, 1702, okay? So not too bad. Over here we have the 5-year. We got 115 on the upside capture ratio. That's good. 95 on the downside capture ratio, so not too bad. And it's better than the category. So these are things that I like to see. Looks good. Negative 16% on the maximum drawdown from peak to trough. Also, actually, very good. I mean, I actually am very happy to see a 16% loss for the maximum from peak to trough, and over a 2-month period. Remember that. Okay, so for number 2, the Vanguard Consumer Discretionary Index Fund ETF, which is ticker symbol VCR. So the deal with this one is I made a video about my favorite sector ETFs for 2021. I'll link it here and in the description below. Take a look at that. But consumer discretionary was one of the sectors I'm bullish on for the year. And so one of the reasons I have this in here is because I do think the sector can perform well this year. That's my thesis, at least. So that's one of the reasons I put it in. And then at the same time, it's also, a good growth ETF. So just take that with a grain of salt. I am bullish on the sector. If you're not bullish on the sector, maybe this one's not for you. So let's go to the product summary. So it seeks to track the performance of a benchmark index that measures the investment return of stocks in the consumer discretionary sector. So pretty easy. It's passively managed fund. So that's it. It's just trying to track the sector. And so it's pretty self-explanatory. So if we go to the expense ratio, like most Vanguard ETFs, like I've said, 0.07, nice low expense ratio. The category rank, it's in the top 10% best in its price returns for the category. For the growth of $10,000 over 5 years, it's grown $10,000 to $24,204 in 5 years. It's a great growth. And the distribution yield, 1.71. So you actually get some yield on this one. So the top 10 holdings in this, by the way, you will see are very highly skewed towards Amazon and Tesla. So you might want to take this one with a grain of salt. There are 300 holdings in this. However, if Amazon does not happen to have a very good year this year, if Tesla does not happen to have a very good year this year, it could be rough. So, just remember this. If you don't believe in Amazon or Tesla, this one may not perform as good as well either. So take that into consideration. Just remember. But you've also got things like Home Depot. That's 5.97% of this. Nike's in here, McDonald's, Starbucks. So nice consumer discretionary companies. So nice, pretty good companies. You've heard of a lot of these companies. Okay, next we have the VCR returns. Now this is the growth of $10,000 over a 5-year period. And this does include reinvesting the yield that this ETF does spin off. So 24,204 is how much the 10,000 would have grown to. This is the blue line here, and you can see it compared to the MSCI ACWI NRUSD, which is the index this thing is kind of looking at, and then the consumer cyclical category from Morningstar. So it's actually done better than both. So this one's actually done quite well. If we just look at the price returns, which don't include the yield being reinvested, the market price for the 1 year, 48% versus the category, 49%, versus the benchmark, 16.25%. This thing's done pretty well. So, like I said, this is a pretty good ETF. And then if we take a look at the risk, of course, very important part, remember the Morningstar risk profile. We got a 5-star fund here, so that's pretty good. The risk versus the category is average, but the return is above average. So that's what you want to see. Average risk, above average return. The volatility measures 9.33 for the alpha, so that's the outperformance, so a higher alpha. As you know that this is done pretty good, comparatively speaking, so it has a higher alpha, of course. And then the beta, though, is also a bit high. So 1.32 is a high beta, and beta is volatility versus, let's say, the S&P 500. The S&P 500 fell, just for an example, what's volatility? S&P 500 falls 5%, maybe this falls 6 or 7%, right? Maybe it goes up 5%, maybe this goes up 6 or 7%. So you're really trying to figure out the beta is the versus the index. It's the volatility versus the index, and then you have the standard deviation, which is the range in prices. So a large standard deviation means that it's had a wider range, which means it's more volatile because you're seeing a lot more movement of the stock price. And then 25 is, a little bit high versus 23 and 26.72. So there you go. And then the capture ratio is the very important part that I always like to look at. The upside, 143. So tons of upside this thing's capturing on the 3-year. And the downside, 108. So not too bad on the downside, and only a 23% maximum drawdown peak to trough. Then we have 128 for the 5-year upside capture ratio, and 106 downside capture ratio. Also pretty good. 23% drawdown ratio, not too bad. So this thing actually is looking pretty good. I really tend to like this ETF. And then the number 1 here I have is the Vanguard Information Technology Index Fund ETF shares, VGT. Now I put this on here because I know a lot of people really love the tech sector, and this is a tech sector type ETF. Now the thing is, if you watch my video on the sectors that I like for this year, I was not as bullish on the tech sector. I slightly underweighted it, not by a lot, but I did think the tech sector, due to the past few years, has had quite a lot of overperformance, and I just thought maybe this year would be a year for some other sectors. Now, that being said, if you like the tech sector, which a lot of people do, then this one could be for you. So the VGT seeks to track the performance of a benchmark index that measures the investment return of stocks in the information technology sector. Pretty easy to follow what this one does. Okay, so for VGT's expense ratio, we have 0.10%. Like I said, Vanguard's ETFs have nice low expense ratios. The 5-year category rank in the top 31% best. Now, I want to talk about this real quick. So the thing is, when you look at these tech sector category rankings, you're going to see like in the top 1, 2, 3, 4, 5% best performing, some things like semiconductor ETFs and things like that. So they're really subcategories of the tech sector. So in my opinion, it's totally fine to have a more broad sector ETF like this one, VGT, that has a lot more different companies, not just semiconductor. So that's the way I look at it. Don't really mind that the 31% ranking is there. The growth of 10,000 over 5 years grew to 34,678, the highest growth out of any of these I've showed you over the 5-year period. And then the distribution yield, 0.82%, not much yield, a little bit of yield. So for top 10 holdings of VGT, we have, of course, the big ones. We got Apple, we got Microsoft, Visa, Nvidia. These are growth ETFs. They're investing in growth companies. A lot of these things I'm talking about, you're going to see some overlap in some of these, of course. So those are the top 10 holdings. VGT's returns, now remember, these include reinvesting of the yield. So VGT grew to 34,678, the blue line, versus the technology sector Morningstar category. So versus 30,000, so this is outperformed. And then it's done better than the index, so also very good. Returns, they're pretty amazing. 48% price return for the 1 year. Versus the category though, 48%. So the category is also crazy high. Broad-based benchmark 16%. So way outperforming there. Just moving on here to get this thing over quickly. Don't want to make this go over 20 minutes like a lot of my videos. VGT risk. We got VGT 5-star fund with Morningstar. Pretty awesome. We got average risk. We got above average return. So those again are what you want to see versus the category, of course. Alpha 17 outperformance. Beta actually a lot lower of a beta than the last ETF that I showed you. So pretty good. Standard deviation also lower than the last one I showed you, so pretty good. Partly because technology has been in favor lately. It's lots of momentum, a lot of people investing in tech, so you get a lot of upside, less downside. So it's been a good past few years. VGT's capture ratio, so we have the 3-year 155. Look at that for the 3-year capture ratio. That's awesome. First, the category 144. So it's getting a lot of that upside. And then the downside, it's actually not really getting as much as the downside at 94. So pretty good as well. We got a negative 17% only for the maximum drawdown peak to trough. I like it. And then you have over here on the 5-year volatility, again, 155 on the up, only 96 on the down. And then the category at a 98 on the down. And then, of course, VGT had higher on the up as well. And then again, still 17.31, the largest peak to trough drawdown. So that is it. Those are the favorites for me for Vanguard, the 3 best growth ETFs. So let me know what you think in the comments. I'd love to hear from you. I want to know if you were investing in any of these ETFs. Did I miss anything with Vanguard? Let me know. Ask me a question if you think I should have had another one on here and why I didn't include it, because I looked at pretty much every single Vanguard ETF to figure this one out. All right, so that's all we have for this video. So please hit the like button, subscribe, and watch another one of my videos on the end screen coming up right now.